With just a couple of weeks remaining in 2024, we hope that our clients and associates have a healthy and fulfilling holiday season, and we wish all of you a Merry Christmas and Happy New Year. As the year winds down, investment markets rarely take a breather, and this year was no exception, as on December 18th, the Federal Reserve Bank, or Fed, held its final policy meeting of 8 scheduled in 2024. As expected, the Fed reduced its overnight bank lending federal funds, or Fed funds, interest rate target by 0.25%, or 25 basis points, to a new range of 4.25% to 4.5%. Although the move was widely and correctly predicted, stock prices plunged after the Fed's press conference as the widely followed S&P 500 equity index closed down 3% for the day. So what happened? Well, it was a hawkish rate cut. The Fed funds rate is an overnight rate that banks lend to and borrow from one another to meet short-term liquidity needs. Other borrowing rates across the economy are either tied to or impacted by the Fed funds target. But longer-term borrowing rates, say 5 years and 10 years, are less impacted by Fed policy. When the Fed is lowering interest rate targets, that creates easing credit conditions and promotes lending. So a declining Fed interest rate trend is called dovish policy. And when the trend is to raise rates and restrict credit, it's hawkish policy. When the Fed cut its interest rate target this week, it was the third rate reduction since September, totaling 100 basis points. And just 3 months ago, the Fed funds range was 5.25% to 5.5%. So now it's a full percentage point below that. This trend lower should be dovish, but it was still called a hawkish rate cut. While the Fed announced that quarter-point reduction, it lowered its estimate for the number of additional interest rate cuts in 2025, which would keep the Fed funds target higher than its prior estimates as the Fed pauses before it hopes to cut further. This sent investors scrambling to consider the impact of higher than expected rates next year in their analysis, and longer-term interest rates, which as I said are market traded, actually moved higher. The yield on the U.S. 10-year Treasury bond moved above 4.5%, its highest yield level of the year. So the Fed said that its policy change was due to 2 factors. Number one, inflation, while improving in recent months, has not dropped as much as it expected. And number 2, the promises of widespread tariffs imposed by incoming President Trump create elevated uncertainty for the Fed, and a pause gives them more time. So what does this mean for investors? Well, for fixed income investors, this can possibly lead to higher interest payments than previously expected, but with more uncertainty if interest rates continue to fluctuate. For equity investors, the near-term path is uncertain, as many December returns have now turned negative and are eroding post-election gains. But economic and earnings trends remain positive, and investors will balance a positive outlook with high valuations. Equity markets in the second half of 2024 have seen sector rotation to include a wider group of sectors and companies, and we expect this rotation to continue in 2025. Avoid becoming over-concentrated in a narrow segment of the market and remain broadly diversified. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.